Welcome back to my channel. Today we are going to see about theory base of accounting. In our previous chapter, we saw introduction of accounting. If you have not seen, the link would be in the description. Click on it and you see it. Now let's start with our theory base of accounting. General accepted accounting principle, that is GAAP, refers to the rules or guidelines adopted for recording and reporting of business transaction in order to bring uniformity in the preparation and the presentation of financial statement. In certain accounting periods, there are like certain principles, concepts, then there are certain rules and guidelines, and to develop over a period. To develop over a period, what is the period of financial accounting? We have some financial period. What is that? That would be, we have financial period, that is it. The financial period, it starts from 1st April and it will end to 31st March, to give the uniformity and consistency. Uniformity and contis to the accounting period and enhance its utility to the different users. We don't have in accounting, we don't have the particular person in particular person. If it the company would be changing, or it would be commenced by different persons, so they every person should have the accounting information in a proper manner. So we have to follow in a uniformity. The different users will also be getting different users will also be getting the information properly, and they would be getting an idea of accounting about the accounting information of the business, like whether it is whether the business is running in profit or whether it is running in loss. They would be getting in the accounting information. We saw about the general topics. Now we introduction. Now let's see the basic accounting concept. What is basic accounting concept? There are certain concepts that we'll see one by one. First, let's see what is basic accounting concept. First, the basic accounting concept are referred to as the fundamental ideas, basic basic assumption underlying the theory and practical of financial accounting, and or avoiding working rules of accounting activity. There are certain activities of accounting, so these are the activities. Let's see one by one. First one is business entity. Business entity. What is a business entity? This concept assumes that basic has destination. The first concept of basic accounting concept, that is business entity. The name itself, it says, and it is a business entity. And business has destinate and separate entity from its owner, and they have two separate entities. For example, ABC Limited. J is the owner, and he cannot trade for his personal use. He can only trade for his business use, that is like engage in trade, business activities, other things, and so on. He can only trade for his business things, not for his personal things. And the types of business entities, there are types of business entities, that is, sole proprietor, business partnership, corporation, etc., and so on. These are the business entity. The second concept is money measurement. Money measurement. The concept of money measurement states that only those transaction only those transaction and and hap- happening in an organization that can only be recorded in the books of accounts. The name itself, it's like the the concept of money measurement states that only those transaction and happening in an organization which can be expressed in terms of money, are recorded in books of accounts. Also the records of a transaction are to be kept not in the physical unit but in the monetary unit. Suppose, like, we have a JLK limited, that JLK limited only uh, M is the owner, and what are the transaction for the business, like they suppose they have purchased goods. They purchase goods of raw materials for the business production, and or suppose they have they have increased the sales, and sales, and what are, like, expenses for the production, expenses for the production, and so on. These are the only for what are the transaction happen in the organization for the production of a product, or production of a product, and so on. Only those can be recorded in the books of accounts. Only these items can be recorded in the books of account, that is monetary units, not the other one. Only monetary units are recorded in the books of account, not the physical one, physical units. The third concept is going concern. What do you mean by going concern? Going concern. The concept of going concerns assumes that business firm would continue to carry out its operation indefinitely, and would not be liquidated in the near future. Going concern is like the business, like the organization, the MNK is a limit. MNK is a limited, is doing its business properly, and it is doing its business without any liquidated in the further futures. They are only earning profits from the past 10 past 10 years, or um, past 10 years, or like they are earning from the production of from like profits from the past 5 years or something. Only they are going good, that is called going concern, without any liquidity. They are not going into a loss. Suppose if the business is going into a loss, they have to liquidate or they close the business. The business is going going in profit, it is called profit without any without any losses. It is the concept of going concern is the organization we should not go into a loss for a long period of time. Then the fourth concept would be accounting period. As we saw the accounting period, what is the accounting period? As I explained in first, like in the definition of in the definition, it's a theory based definition itself. What is the accounting period? We have certain accounting periods like span of like from the we don't continuously record the books. We have to do certain the accounting period. What is the accounting period? That is first April to 31st March is the financial accounting period for the accounting. Refers to the accounting period refers to the span of time at the end of which year they have to prepare financial they have to prepare financial they have to prepare financial statement of an enterprise and prepare to know whether the organization is going under profit or it has incurred into losses or during the period. What was the exact position of the assets and liabilities at the end of the period in the organization? The next concept would be cost. What do you mean by cost? The cost concept refers to that all the assets are recorded in the books of accounts at their cost price, which includes the cost of acquisition, transportation, installation, and making the assets ready for the use. The cost, like whether if we have purchased a machine, um, how much is the installation cost, for installation cost, and they have some repairs if there are some repairs and maintenance cost. This has to be recorded in the books of in the cost in the cost concept we have to record in the books. And there are certain concepts, that is like transportation, selling cost, selling things, and that is indirect materials of sellings that are that we have to record in the cost sheet. The next concept is dual as asset aspect. Dual aspect. What is the dual aspect? This concept says that every every transaction has a dual or twofold effect twofold effect on various accounts, and should thereof be recorded in two places. The dual principle is commonly expressed in terms of fundamental accounting equations, which is that is assets, liabilities, plus capital. Dual assets is like we have to record in, mostly it comes under cash book double entry. It is also called double entry system itself, which has to the transaction for personal use we have to record in the cash side also, and in the bank side also. We there, that is when we are preparing a cash book or cash book and double entry system, when it comes under double entry system, this effect would be there. That is dual aspect effect, and there is a certain formula for this. That is assets is equal to liabilities plus capital. If we add these liabilities and capital, we'll get assets. The next concept would be revenue recognition. Recognition. Revenue recognition. Revenue is a gross inflow. Revenue is the revenue is the gross inflow of cash arising from sale of goods and services by the enterprise, and use of others of the enterprise resources, adding interest, royalties, and dividends. That are the the concept of revenue recognition requires the revenue of the business transaction should be uh, consider realized when a legal rights to the receive which arise. This is like revenue recognition is the growth of is the growth of gross inflows. Revenue recognition is a gross inflow of cash arising from sales of goods and services by the enterprise, and use of others of the enterprise. The next concept is matching. What is matching? The concept of matching enhance that the expenses incurred in an accounting period, that expenses incurred in an accounting period, it should be matched with the revenue during the period. Revenue during the period that period, and it follows the revenue and expenses. It follows the revenue and expenses incurred to earn revenue must be to the same of the accounting period. The matching is like whether the expenses expenses of accounting revenue and revenue and expenses of a accounting period, where it should be same, what and all it happened in the in that particular accounting period, it should be matched. That is called matching concept. What is the next concept? That is full full disclosure. Full disclosure concept. What do you mean by full disclosure? What do you mean by full disclosure? This concept requires all the materials, relevant facts concern financial performance of a enterprise must be fully and completely disclosed in financial statement and their accompanying footnotes. And these are the fully disclosure. And next one will be consistency. What do you mean by consistency? This concept states that accounting policies and practices follow enterprise should be uniform and consistent one the period of time so that are comparable result when the same accounting principle consistently being applied by different enterprise for period under company or the same fund for the number of periods. Now let's see about conservation. What is conservation? The concept requires that the business transaction should be recorded in such a manner that profits are not outstanded, all anticipated losses should be accounted for, but all the unrealized gain should be ignored. That is conservation. The next concept is materiability. This concept states that accounting should focus on material facts. The items is likely to influence the decision of a reasonably investor or investor or creditors. It should be regarded as material and show in the financial statement. This is materiality. The next concept is objectivity. According to the concept, the accounting transaction should be recorded in manner that so that it is free from the bias of accountants and others. This is accountability. Now we saw all the basic accounting uh, concepts. Now let's see the system of accounting. In system of accounting, there are two types, that is double entry and double entry and single entry. In double entry, if we come under the double entry, the name itself says that they are double transaction has to hold the effect where the where in the single entry should be has a income records. In single entry, you remember that in single entry there should be only income records, and in double entry the two-fold effects transaction of has two-fold effects. And the next concept is base of accounting. What is the base of accounting? In that itself there are two types, that is cash basis and accrual basis. What do you mean? The two board approaches of accounting are cash based and accrual based. Under the cash based, transaction are recorded only when cash are received or paid, whereas in under accrual basis, revenues or costs are recognized when occur rather than they have paid. The cash basis like only when there is a cash transaction, that is cash basis. If we come under the accrual basis, that is like revenue, cost and recognized with other when they are paid. Like next would be the next topic would be the accounting standard. Let's see what is accounting standard. Like accounting standard are written statement of uniform accounting rules and guidelines in practice for preparing the uniform and consistent financial statement. These standards cannot override the provision of applicable laws, customs, usages and business environment in the country. As we saw in the first the introduction of accounting, that is general accepted accounting principles, GAA, that like in the similar way there are also certain rules and regulations, practice and preparing the uniform manner the consistency of financial statement. And in accounting standard there are certain laws, like certain applicable laws, customs and usages and business environment in the country. we all we have covered all the topics in the theory base of accounting. If there is any topic pending, we can comment on down, like in comment section you can comment on the topic, and I would be explaining in the next video. If you like this channel, subscribe to my channel and click on bell button to know all the notification of my our channel. And if you like this channel, like our channel, and if you want if you want to share this, share with your friends, and